Today, we're diving into one of the most eye-opening financial comparisons you'll ever see. We're analyzing how $2 million in taxes just vanished due to perfectly legal Amazon loopholes, and what this tells us about the real path to retirement wealth. Let me start with a headline that caught everyone's attention. Amazon, one of the world's most profitable companies, paid zero federal income taxes in 2012 and again in 2018. How is this possible? The answer reveals everything about how wealth is actually built in America. Here's the shocking reality. A $250,000 dentist and a $90,000 employee might end up with completely different retirement outcomes, not because of their salaries but because of how they structure their income and deductions. Let's start with the dentist's advantage. Consider Dr. Sarah Chen, a successful orthodontist earning $250,000 annually. On the surface, she pays significantly more taxes than Mike, who earns $90,000 as a software engineer. But here's where it gets interesting. Dr. Chen owns her dental practice. This single fact changes everything. As a business owner, she can deduct virtually every legitimate business expense. Let's walk through her actual deductions. First, office rent and equipment. Dr. Chen's practice space costs $8,000 monthly. That's $96,000 annually, completely deductible. She purchased $45,000 in dental equipment this year. Through Section 179 deductions, she can deduct the full amount immediately rather than depreciate it over time. That's another $45,000 off her taxable income. Second, employee salaries. She employs a receptionist, $35,000, dental hygienist, $55,000, and assistant, $32,000. These $122,000 in salaries are fully deductible business expenses. Here's the critical part: she can employ family members. If she hires her spouse or adult children at reasonable market rates, their salaries become her deductions while potentially keeping money within the family. Third, continuing education and professional development. Dentists must complete continuing education courses. Dr. Chen spends $12,000 annually on conferences in Las Vegas, San Diego, and Miami. Hotels, flights, meals, and registration, all deductible. The IRS requires these to be legitimate professional development. And they are, but the location hardly matters for the deduction. Fourth, health insurance and retirement contributions. As a self-employed individual, Dr. Chen can deduct 100% of her health insurance premiums, a deduction that W-2 employees don't get. She can also contribute to a solo 401k up to $69,000 annually as of 2024, compared to the $23,500 limit for regular employees. Better yet, she can contribute an additional 25% of her net self-employment income, bringing potential contributions to over $100,000 yearly. Fifth, home office deduction. While she has a practice location, she also deducts part of her home. She uses her home office for administrative work, continuing education, and professional reading. At $0.05 per square foot simplified method, her 300 square foot office generates $1,500 annually in deductions. More importantly, this includes utilities, internet, phone, and depreciation. Sixth, vehicle and mileage. Dr. Chen drives to multiple dental conferences, supplier meetings, and professional meetings. She tracks 18,000 business miles annually. At the 2024 IRS rate of $0.67 per mile, that's $12,060 in deductions. This includes gas, maintenance, insurance, and depreciation, all covered by the mileage deduction. Seventh, supplies and materials. Dental supplies, gloves, anesthetics, impression materials, sterilization equipment easily total $40,000 annually, all deductible. Eighth, professional services. She pays an accountant $5,000, an attorney $3,000, and a dental consultant $8,000. These professional service fees total $16,000 in deductions. Now let's add it up. $96,000 rent, plus $45,000 equipment, plus $122,000 salaries, plus $12,000 conferences, plus $8,000 insurance estimate, plus $1,500 home office, plus $12,060 mileage, plus $40,000 supplies, plus $16,000 professional services, equals $352,560 in deductions. Wait, that's more than her $250,000 income. How does this work? Through something called business loss carryforward. In years where her legitimate deductions exceed her income, she can carry losses forward to offset future income taxes. This is perfectly legal and accounts for how many successful business owners pay minimal taxes. But here's where Amazon's strategy enters the picture. Amazon's $2 million in vanished taxes wasn't from the strategies we just discussed. It was far more sophisticated. Here's what actually happened. Amazon, founded by Jeff Bezos and now led by Andy Jassy, reinvested virtually all profits back into the company. Stock-based compensation for executives and employees created massive tax deductions. When employees exercise stock options, companies can deduct the difference between the exercise price and fair market value. For a high-growth tech company like Amazon, this spread could be enormous. For example, if an executive received stock options at $100 per share and the stock was worth $300 when exercised, the company deducted $200 per share. With thousands of employees and millions of shares, these deductions reached billions. Additionally, Amazon utilized research and development tax credits. The American Jobs Creation Act of 2004 allows companies to claim credits for domestic research and development expenses. Amazon's AWS division, investment in drone delivery technology, cashierless stores, and AI systems qualified for these credits. These aren't deductions, they're direct credits against taxes owed, making them even more valuable. The company also utilized loss carryforwards aggressively. In the early 2000s, Amazon operated at a loss or minimal profit despite massive revenue, investing everything in infrastructure and expansion. These losses could be carried forward for years, offsetting taxes in profitable years. Was this illegal? No. As tax expert David K. Johnston documented in his research, Amazon was following the law. The strategy reveals a critical truth. The tax code is written by and for people and corporations with resources to understand it deeply. Now let's examine the $90,000 employee's situation. Mike, our $90,000 software engineer, faces a completely different reality. His employer withholds taxes throughout the year. By December, roughly $18,000 has already been removed from his paychecks, assuming standard deductions and a modest tax bracket. Mike can claim the standard deduction of $14,600 2024 single filer, reducing his taxable income to $75,400. His tax liability is approximately $8,500, but remember $18,000 was already withheld. He'll receive a refund, which sounds good until you realize that's essentially a tax-free loan to the government. Mike's deductions are severely limited. He cannot deduct commuting costs even if he drives 45 minutes each way, home office expenses, even though he works remotely 3 days weekly, professional development, the $2,000 coding course he took, work-related meals or entertainment technology equipment he purchased for work, professional association dues. Could Mike start a side business to access these deductions? Yes, and many people do, but it requires genuine effort and real business income. The IRS scrutinizes hobby losses carefully. If Mike started a consulting side business earning $10,000 annually, he could deduct legitimate expenses, but only those directly related to the consulting income. Here's the structural disadvantage. Mike's retirement account options are also limited. He can contribute to a traditional IRA $7,000 in 2024 or a Roth IRA. If his employer offers a 401k, he's limited to $23,500 annual contributions. Compare this to Dr. Chen's potential $100,000 plus in retirement contributions, and the long-term impact becomes clear. The wealth-building math over 30 years. Let's project forward. Dr. Chen invests her tax savings and additional retirement contributions. Let's say she saves $60,000 annually through strategic deductions and maximized retirement contributions, money Mike cannot access. At a conservative 7% annual return, that $60,000 annually becomes year 10, $925,000 year 20, $2,760,000 year 30, $6,730,000. Mike, meanwhile, invests his after-tax income. If he saves $30,000 annually, half of what Dr. Chen saves because he has less tax-advantaged options. His 30-year projection is year 10, $462,500 year 20, $1,380,000 year 30, $3,365,000. Dr. Chen ends up with roughly double the retirement wealth, not because she earned nearly 3 times more income, but because her business structure allowed tax-advantaged wealth accumulation. The counterargument and risk factors. Now let's address the risks. Operating a business means self-employment taxes. Dr. Chen pays approximately 3% self-employment tax on 35% of her net business income, roughly $35,000 annually on her $250,000 income. Mike's employer covers half of Social Security and Medicare taxes. This is a real cost. Also, not everyone can realistically open a successful dental practice or similar business. Starting a practice requires significant capital, education, and risk. Many business owners fail. Studies suggest 20% of new businesses fail in the first year. Additionally, aggressive tax planning has limits. The IRS increasingly scrutinizes business deductions. In 2023, the IRS announced plans to increase audits of high-income individuals and small business owners. The hobby loss rule prevents individuals from deducting losses from activities that don't appear to be legitimate businesses. Finally, some deductions seem aggressive but survive audit. Others don't. A Miami dental conference is legitimate. Deducting a personal vacation as a conference is not. The line can be gray. The final insight, the $2 million in vanished Amazon taxes, ultimately teaches us that wealth isn't built primarily through income. It's built through understanding and utilizing the systems designed to encourage business investment and entrepreneurship.